Hello, everyone, and welcome to another seminar from Elliott Wave Forecast. My name is Eric. I'm the founder and CEO of Elliott Wave Forecast. As we do every month, today is a day in which we're going to do a seminar, a free seminar to our followers around the world, in which we're going to present a, a long-term, view of the market in one instrument. Sometimes we do it about instrument that we cover. Sometimes we do about instrument that we don't cover. So this is the video review of the seminar that we did early in the day. And what we're gonna do in this video is to put in conclusions the opinions that we present in the seminar, so you guys followers can have it, save it in your computer, and keep it for future reference. Today's seminar is going to be about oil, and what we're going to explain is how we in Elliott Wave Forecast we draw the conclusion that oil should be supported. We're going to explain the reason why besides Elliott Wave, and we're going to explain why oil should be very soon a good instrument to buy in the dips, and why we recommend it to do so. So first of all, let me give you guys a little information about Elliott Wave Forecast, who we are, and how we do operate. So as presented here, Elliott Wave Forecast, we are a team of technical analysts that we all have a different background, but we most of all we agreed in kind of an engineer background. We've been in business in 2005, and we really started the process doing Elliott Wave Forecast as an orthodox Elliott Wave service. In other words, that for us everything was 1, 2, 3, 4, 5 ABC. With the years of application of the system, of the principle, we noticed that the principle many times was giving us false indications. We saw that so many times we saw a 5 weeks, and we go after the 3 weeks back for the next for the extension in the direction of the 5 weeks, and the index and the instrument that did everything bad, trading in the direction of the 5 weeks. It's understandable. I mean, the Elliott Wave system principle was developed in the 1930s, and consequently with that, the principle of Mr. Elliot didn't have enough tools to develop what we have today, and that's what we draw conclusion about it. And rather to give out on the principle, we spend a lot of time and resources to develop a system, which include a swing sequence analysis, cycles, correlations. We also have a proprietary system of trading that we call it the right side system, to locate the right side of the market. We use Elliott Wave, yes, but most of the time the Elliott Wave that we use it as a language. And we got the edge from the market sometimes using Elliott Wave, but we don't do nothing based in Elliott Wave. We look for confirmation in the sequence, the swings, the cycles, the correlations, and the system of distribution, how we call it, which provide us with the right side of the market. It's very different, and I advise you guys all to open your mind. What you're gonna hear for the next 20 or 30 minutes, this is a conclusion of the video. The seminar was a much bigger, so we're doing a conclusion so everyone understand the bullet points about the seminar is that you guys need to open your mind. You guys haven't seen anything like this across the market, and it's gonna be different. But our hope is that you guys becomes better trader and understand that this is not about the trade war with China. This is not about tariff. This is not about non-farm payrolls, the Fed, or anything. This is about a few group of people with a lot of money that makes the market, and trade the market in a very technical manner. Me personally, I don't find or I don't use anything related to fundamental trading. All my trading is based in Elliott Wave, in sequences, in a swing correlation, cycle correlation, and the pivot or distribution system. I always enter the market at the blue boxes that most of you guys have seen around our store tweet handle, YouTube channels, and on and on and on. And everything is based on the blue boxes, which are high frequency trading boxes. In that area, the market always agreed in a reaction. Why? Because the blue boxes are area in which the market, if they are sellers, the seller's gonna take profit at the blue boxes, but the new buyers is gonna enter in the new boxes. So there is agreements into the two sides, right? So more or less that's the overall idea about what we're gonna be covering in the seminar. And the first thing that we're gonna do is we're gonna start here with oil. It's about oil, right? So we're gonna explain the Elliott Wave structures of cycle in oil. We're gonna explain the 5 ways out from the all-time low. We're gonna explain the 3 ways back. The 3 ways back, we know divergency in RSI. That's the first things that we're gonna do, right? So let's go and show the oil grand super cycle degree and the super cycle degree, and let's explain why we believe that the pullback in oil that started in 2008 completed, and now it's gonna be a period of sideways when the instrument is gonna give you highest high, highest low onto a break into the outside. Having said that, let me show you here the chart of oil, and this is oil from the all-time lows over here. We are assuming this is the zero line in oil over here. This is zero. So oil have never traded below that blue box. And we in Elliott Wave Forecast, we were using and we were waiting for these opportunities that oil trade below this low as a long-term buying opportunity in oil. Now, based on the Elliott Wave theory, I want you guys to understand how what the theory say. The theory say that after 5 ways up, here 1, 2, 3, 4, and 5, they're gonna be 3 ways back in the instrument. I mean, in any that's the famous Elliott Wave pattern. So it's 5 ways out and 3 ways back. All right. So technically, in this structure, you got 5 ways, 3 backs, and the 1 with parenthesis degree. Then you have another 5 without parenthesis here that makes 3, a 4, and a 5, and that makes the 1 with the round. So technically, that's the pattern, and that's exactly what oil is showing here. You have 1, 2, 3, 4, and 5. Then you have A, B, and C. This is very technical, right? And I want you, like I said earlier, that I want you guys to open your mind. Now, this is, like I explained earlier, is the patterns of the Elliott Wave theory, right? A, B, and C, correct? Now, usually from this peak over here, the instrument is gonna trade lower, and it's gonna trade to the equal legs, right? Now, that equal leg is what you guys see in our charts that comes with a blue box. Now, oil is very interesting. Why? Because in the financial crisis of 2008, oil did very sharp to the downside. And the low in the financial crisis was around 33. Now, oil recovered in 3 weeks, and then oil, again, it went and it traded lower, but The blue box it collects from this peak, and assuming that this peak is the equivalent to this peak, the blue box right there it collects is gonna be oil around $1 the gallons. And as you guys know, that ain't going to happen. That's not possible, right? That's not possible there to happen. Now, so oil, we knew that it was impossible. We knew that it was impossible that oil is gonna trade to 127. We knew that it's gonna be impossible that oil is gonna trade to 127. We knew that. So technically, what oil did is that when the market do not reach the blue box, it collects, the market is gonna bounce from the next area over here. And the next area is the 618 over here of the first two legs. In other words, it was unrealistic that oil here is gonna reach the equal legs or the relationship in the equal legs here between A and B in blue. Why? Because it's gonna put oil at 0 or minus $25 per gallon. So what the market did is that the market it reached this blue box at the 618. It did the minimum in breaking this law. So technically this is an ABC. So instead of reaching the equal X, oil did the 3 ways back and react from a and react from the 618 area over here. This 618 is the equivalent in the pattern over here. What I'm saying is that if you look over here, A related to B, 85% of the times are equal. But C, it should be equals to A related to B. But it needs to make sense. And in the case of oil, it didn't make sense because let's be realistic. Nobody's gonna see oil trading at $1 a gallon. So at this stage, oil, this is the grand super cycle. It did 5, 1, 2, 3, 4, and 5, and it did 3 ways back. Now, I want you guys all to take a look at this. I want you guys all to take a look at this day. This is 2008. This is 2011. In other words, from 2008, it did 5, 3, and another 5. And now, this law, which is the January of 2016, it becomes a very significant law in oil. It becomes a very significant law in oil. Now, let's take a look at this 3 ways decline. With that, we're gonna go to the super cycle degree. And like I say, the instrument did a peak in 2011, and it did 5, a clear cut impulse, 3 weeks back, and then 1, 2, 1, 2, 3, 4, 5, 6. In other words, 1, 2, 3, 4, 5, 6, 7, 8, and 9. It did right there. At ABC, there is no divergency because this law in the RSI is lower than this law, and that's one of the conditions that we in Elliott Wave forecast in our new rules is very simple. When you have an ABC, like it is the case over here, this law not only needs to trade lower in price than this one, but the RSI momentum reading in this law also needs to be lower than this one. Having said that, this is completed here because when you look at the RSI in oil, there is the peak, the low, the secondary peak, and the next low. And then the divergence here, which is showing one divergence, two divergence, three divergence, which is what we call the tree drive divergence. In other words, that the market give you three divergences. That's the minimum needed number of divergence to finish a five-way impulse. So we believe that oil right there, we believe that oil right there has ended the cycle if we trace the 2011 cycle for sure. But if you trade here a trend line and momentum, you can see that yes, over here oil did hold the trend lines and price, but in momentum it breached higher, meaning that we believe that the 3 weeks put back as an ABC and oil has ended there, and that realistic here, the next leg higher has started in the indices. I want you guys all to understand that if we look over here, oil soared early, late, on the middle, on the summer of last year, but it's sold for the blue box right here. This blue box is the equal legs from this one related to the two. Now, oil seems like it has the perfect pattern of Elliott Wave, which is that you have 5 weeks followed by 3. Right here on the yearly, you have, without a doubt, 5 weeks out followed by 3. So this is the Elliott Wave part of oil that we see. We believe that 2016 over here is a very significant low, and we believe that a multi-year cycle now started. Now, I want you to understand this is not gonna be that like this, right? That's not what we're saying here. That's not what we're saying here. Ain't gonna be like this, right? So technically, this is gonna be sideways, and the market is not ready. Is not ready for a huge rally yet at this stage. Now, we're gonna explain to you guys something that we do in the daily basis in Elliott Wave Forecast. We're gonna explain to you guys something that we do in our daily basis. That is that, like I say earlier, we use cycles, sequence, correlation, multi-market analysis, and we use distribution system plus Fibonacci levels, which to create the extension of the market, and also we use Elliott Wave as a language. Right? Now, at this stage, what I want you guys to understand is the following. We understand that in the market, you cannot forecast the market without using market correlation, right? So the market correlation is something that we have taken in Elliott Wave Forecast into another level. Why? Because without it, you're going to be dead in the water. You ain't going to survive in trading. And what we have done is we divide the market in the different groups. Indices, commodities, dollar pairs, yen pairs, commodity currencies, commodity itself. Of course, that the indices are very well related to the yen pairs. But at the end of the day, the CAD yen is the same as the dollar CAD. Because at the end of the day, that you can get a rally in the dollar CAD to the upside, right? But the CAD yen won't drop. I'm sorry, the CAD yen won't rally. The most that the CAD yen will do is stay sideways. And it depends on the dynamic. So the way I see it is that we believe that the market act as a whole, and consequently, because the market act or trade as a whole, we believe that the market, in reality, you need to look at it and say, okay, if I'm calling oil higher, there is no way that silver is gonna trade lower. Why, guys? Because both trade within the same, both are commodities. But at the same time, within the commodities, you have, with the same times, within you have, for example, the Cajun. What is the Cajun? The Cajun is a commodity currency, correct? The Cajun is a commodity currency. So if the Cajun is going to trade lower, that means that the yen is stronger than the CAD. But that means also that the yen is strong. And if the yen is strong and is stronger of the than the CAD, that generally means that oil, it will suffer. Why oil will suffer? Because the CAD yen lower means CAD weakness. So with CAD weakness, oil won't rally. It's a lot of stuff within the market correlation. We have developed a system, a different type of correlation. First dimension correlation, second dimension correlation. Nobody in this planet has ever used, other than Elliott Wave forecast, nobody has ever used what is called second dimension of the market. The second dimension of the market is when the market does agree in swing but not in direction. The first dimension is the easy one, the one that everyone can see, is the first degree correlation. What is the first degree correlation? The easy one is the one that you see that, for example, oil trade higher and silver trade higher. Why? Because silver is a commodity trading against oil, against the dollar, right? Silver is a commodity trading against the dollar. That's what silver is. But oil is also a commodity trading against the US dollar. So having said that, I'm going to show you guys this chart of silver over here, in which silver and our members being told to buy silver, send the lows over here around 2015. I want to overlay here and put the date of that peak. That's 2011. And this low in silver is nothing more than December of 2015. Now, what silver did? It's a commodity trade. So what silver did is that silver trade lower in what is called a 7 swing structure. 1, 2, 3, 4, 5, 6, and 7. Right? It did an ABC here that it went to the blue box, it collects, bounce in 3, and then it reached the blue box in blue. So now silver is starting to react higher. What is the coincidence here? It's very simple. Like I say, using market correlation, we believe that silver ended the cycle from that peak, right? Silver ended the cycle from that peak. Now, what does that mean? How does it affect oil? It's very simple, guys. It is the same trade, right? What makes sense? The thing is that oil didn't make sense to trade into the equal legs. Why? Because the equal legs in oil, like I said before, is gonna make oil to reach around 0 over here. But in the other hand, silver, it makes sense because it trades at 1371, which is the equal legs. So silver did reach the equal X. Oil ended at the 618. But what is no coincidence is the following, is that if you overlay oil in top of silver, it is the same trade. I'm gonna contract it a little bit, and you guys gonna see how, if I remove the labels for the bid, you're gonna see an outtrend in both of them decline here, both of them rally. Identicals. And then now I want you to look at it, how silver declined, oil here also declined. Both rally, then both decline, then both rally, then until now, this is what we call the first dimension. They are identicals. They agreed in swing and direction. Now, this is very easy to see. Now, I want you guys to pay attention to this specific period right here. From there, we can see how silver decline, oil right here remains sideways. That's a second degree correlation because they agreed in the internal swings, but not in the direction. Because oil did a decline, silver did. Then silver bounced over here, and oil bounced, and then this period here, again, they agreed in first dimension. So outside of this area highlighted here in blue, the trade is identical. But the key is that as a trader, I always remember, you always ask yourself, what can be the alternative view, right? Let's say that I want to make an oil, and that's the key in Elliott Wave forecast. We do not provide alternative view. Why? Because it creates noise to the traders. We are here to do the job the right way. We are here to pick the path that makes more sense. We are not here to show alternative 4, alternative 3. No. We do not like that. We would like either to be right or to be wrong, but with a conviction. So technically, yes, as an Elliott Wave guys, I can say this is 1, this is 2, this is 3, this is 4, and oil is gonna break the lows. All right, I can say, like I say, I can move here if I want to and do this. Alternative 3, alternative 4. Right, I will never gonna be wrong if I use alternatives. But we don't operate like that. Our members know that oil was a buy. Our members know what to do with oil from now on. Our members know what to do with silver. So without a doubt, silver ended this cycle. And silver is going to start a recovery that it take it to breaks the highs of 2011. And the same way oil. So using market correlation within the same group is impossible, almost impossible for silver to trade up to here and make another cycle similar to this one after 3 weeks over here. Because why? Because then silver is going to break over here the 0 line. So if silver is going to trade higher, and the low over here in 2015, it was a very significant low, chances are that the same low in oil is a very significant low. And that's the reason why we do not recommend selling oil based on an instrument that is trading the same group as silver. Because oil is a commodity against the dollar. Silver is a commodity against the dollar. I think it's very clear to you guys there. Now, we're gonna use now other instrument not being a commodity but related to oil. And we're gonna start with the commodity index. A commodity index over here, these are the instruments that we're gonna be using now. We're gonna use CVI, which is Energy Inc. And I'm gonna give you the insight of what each of these instruments is telling us about why we need to buy oil instead of selling and the reasons why. Each one have a different reason and why we pick the path that we pick in oil. First, Energy Inc. This is Energy Inc. over here again. And Energy Inc., what is particular about Energy Inc. is the idea that Energy Inc. Over here took the peaks of May 2021. It has the same low in 2016. It's showing 1, 2, 3, 4, 5, and it took the high. That create a bullet sequence because the market either trade like this when it makes three ways back. The moment that it breaks this, it should continue higher. That's an important bullet sequence. And that's what it's taking here. So the worst case scenario in Energy Inc. is that that Energy Inc. is gonna do a flat right here. And that Energy Inc. is gonna do this. But no matter, even if it does that, and it does a flat right there, it's gonna hold the lows because it has a bullet sequence. So Energy Inc., again over here, regardless what the intentions is, if I overlay it with oil, which is pretty much very good, or a very good correlation, is telling me that there is a huge chance that oil retests that trend line around 44 and fly to the outside because Energy Inc. already to the highs that we have last year over here around this area.
Incoming chat.
The second instrument that I'm going to mention here is the commodity index. This is plain simple oil. It's a commodity index, which is an index that index all the commodities, right? And over here, I want you guys to look at 2008 and 2011. But like I say, this index already is trading at the blue box. It's trading at the area. Is trading at the areas in which over here oil couldn't trade, right? It's trading at the areas that oil couldn't trade. Why? Because when we do overlay oil and commodity inks, it's exactly the same oscillation 3, 3, and 5. So this one bit at the string blue box from here is about to trade higher, right? It's about to trade higher. Right? So we believe that commodity inks has reached a string. Now, commodity a commodity right here, my bad, the commodity index is trading at the equivalent of oil trading, like I said before, around $1 because it's the 100% relationship between these two highs. Eventually, it won't do that low. So commodity inc is not letting oil dip more. And like everything is gonna bounce from this area. It will bounce from here, and that will hold oil to rally either from here or a little bit lower here, either from this equal legs or from this equal legs. Oil will rally. Why? Because commodity inks at this stage is at equal legs. It's identical. It's the same trade. So oil, it will be supported because it will be supported because the commodity index, right? Or GCC, like we call it, right? So the way I see it, the way I see it, the way I see it is that GCC or the commodity index is telling me don't sell oil. And like I always tell members, one of the things that the traders always need to do is, and a professional trader I always recommend my clients to do is always ask yourself what not to do. What not to do, right? And right here, what you don't do is selling oil. Yes, oil can drop a little bit. Oil can drop a little bit. Yes, oil can see 44. I don't deny that. Oil can see 44. Oil can drop a little bit, but doesn't make any sell. It doesn't make any sell because it's evident that the intention of the market is to support oil, right? The intentions of the market is for a supported oil. Why? Because the GCC right here, or the commodity indices, it will not allow oil to drop because that instrument is about to rally. So we got the CVI or the energy ink already rallying there, right? In breaking the peaks, breaking the peaks of last year. And now we have over here the GCC or commodity index, and ECOLEX is going to rally. Oil is going to rally soon because this one, it will support it. It's the same height, everything is the same. Another one that I want to show you is, and remember, oil peak or bottom in this wave 3 of the commodity index. So it's about to rally. Now, another one that I'm going to show you is CSK. CSK is an instrument that we cover in the daily basis. And some of you guys in stock tweaks can be asking yourself, why we keep calling it lower in the shorter cycles. One of the reasons was this instrument right here, right? Because we knew that GCC or the commodity index, it needs another low. And we knew that because this one, it wasn't imposed here and it wasn't completed from 2011, we knew that CSK also, it was about to make a new low, right? Because at the end of the day, look at this. This is CSK. Look at the line. That's CSK, and that's the GCC. They're both taking a different Elliott wave pattern. Technically, it's the same. It's an ABC, both of them. But this one here, it needs another low. And that's why we've been calling a marginal new low in CSK. Now, CSK here is providing a beautiful, a 5 weeks decline from the 2011 peak. It has 1, 2, 3, 4, and 5. Look at the RSI momentum divergence there. And unless this one got in bankrupt, I believe that this instrument is about to start a recovery in momentum right here and breach that trend line and start penetrating this area. So as of right now, what do we have? We have CVI or Energy In, GCC or Continuous Commodity Index. We got CSK also telling me don't be bearish oil, don't sell oil. Any dip is a buy, right? Now, you guys may ask yourself, then why we calling this that an oil? This is not a super rally because we can go and we can put wave 1 here, wave 2 here, and anticipate a wave 3 to the upside, correct? We can do that. Now, like I said several times, we are a put a lot of effort in the market correlation, right? And we do understand that oil is a commodity trading against the dollar. We do understand that silver is a commodity trading against the dollar. We understand that CVI or Energy In is an stock related to oil. We understand that Community Index is nothing more than an index that relates commodities, and that CSK is related to oil. But we also do understand that the SecGen over here is also related to oil, right? Right? So, the SecGen, the SEC is a commodity currency. And I want to explain to you guys here what the SecGen is telling me. This is the SecGen, and these are no Elliott Wave numbers. These are nothing more than these are sequences. Now, I want you to pay attention now to what I'm going to show. It's from the peak, it did 3 weeks to the blue box over here. Right? That's a 3 weeks put back, a 3 weeks decline to the blue box right there. Right? And the blue box is the area between the equal X and the 1.618. And that is in the black degree. So that makes 1, 2, 3 in black makes 1 blue. Then 1 blue, 2 blue, it makes 3 blue. And the instrument here went and reached again another blue box over here. Right? Right there. Another blue box. And it bounced. But 3 black makes 1 blue. 3 blue makes 1 red. Right? Beautiful, right? Now, the index here, or the instrument, bounced in 3 waves also to another blue box right here. You guys haven't seen nothing like this. This had nothing to do, like I said at the beginning, with China, with the tariff, with anything, trade wars, any fundamental stuff. This is pure technical. But now, like I say, 3 blacks make 1 blue. 3 blue makes 1 red, right? 3 blue there makes 1 red. Right? And now we are in the process of finishing over here another 3 blacks into this area. What's going to happen? When it reach the SecGen reach 1043 area, the market is going to rally in 3 weeks. And if I go and I do overlay the SEC yen, remember what I say, the SEC is a commodity currency. And the yen strength, what makes the SEC yen to trade lower, it hold oil for rally. I'm gonna overlay now the SEC yen related to oil. Interesting, because it is the same oscillation. Look, from the peak, they trade together up to here. They rallied up to here, and they deepen now. So the SEC yen reaching this area is gonna make oil to rally either from here or maybe from here. But I want you guys to look what happened when the SEC yen rally. But this is the downside here, what I'm gonna explain. That, like I said before, if you look at the structure and the sequence of the SEC yen here does have, right? 1, 2, 3 blacks makes here one blue. 1, 2, 3 blue makes one red. 1, 2, 3 blue, black makes one blue. We need a 2 blue. The 2 blue support oil, right? The 2 blue support oil. But at the same time, the market down the road, and sometimes around the summer of next year, the market is gonna need another cycle lower into the big area, into the reds. In other words, in which after this bounce, the SEC yen is gonna make another rally like this, another decline like this. And that decline, without a doubt, it will make oil sell. So what we're proposing here is that because this is the low in oil, right? Look, that's the low in oil. What we're proposing is that oil is gonna reach equalex over here, and oil is gonna retreat into the retest of the trend line. And what we're proposing here is that when the SEC yen reach the equalex in the blue and the equalex in the red, down the road over here is when the huge rally in oil will take place. In other words, to put it in verse, that the SEC yen over here is holding the oil to be labeled as a blue and 2, and that the wave 3 is going to start. On the other hand, we believe that oil will extend from here, and that's why it comes the over here, the 93, 104 area. That's what we believe, that oil will see the 100 area, right? But sometimes next year, that oil will see the 100 area sometimes next year, because the need for the SEC yen to rally, and also the GCC and equalex. So already relate stocks that they are related to oil, already relate commodities that they are related to oil, and already relate a Forex instrument, which is the SEC yen, that also is related to oil. We are not looking at oil in Elliott Wave only. Now, I'm going to add to this equation the CAD yen, and the CAD yen is another oil-related instrument, correct? And I'm going to put it in top of everything. And the CAD yen is going to do the same oscillation. It's going to do it here, and it's going to do another leg lower. So I would say that this is very technical, honestly, very well defined, and the market is unbelievable well defined. Now, I'm going to use here, these are weekly cycles, and I'm going to remove the cycles. I'm going to put the highest degree, like over here, the monthly bar. I'm going to contract it a bit. And this is the SEG in the monthly bar, correct? Remember that the SEG needs to trade over here into 859. Right there, it is when the real acceleration, this area is when the real acceleration in the SEG is gonna, and the SEG and the indices are going to fly, because this reaction here is yen weakness. Now, I'm gonna put oil back into the SEG monthly chart, and you guys gonna tell me that there is no the same trade. Remember that the equal-X below this low put oil below zero. So the SEG won't drop here in a straight line. The SEG is gonna oscillate, like explained before, like this, and retest that trend line, then it drop. And the path that we believe that oil can take is, and I repeat it, it's gonna do this, and then it's going to put back again. When the SEG reach this equal-X is when the multi-year cycle in oil, it will start. Very well defined over here, guys. Very, very well defined, to be honest with you guys. Now, last, I already explained the Forex instrument, stocks, and the Elliott Wave path of oil. Now, I'm going to explain the indices, because everything is related, right? For example, this is the FTSE from UK, right? And the FTSE is trade related to oil. Why? Because higher indices is yen weakness. Yen weakness is oil higher, because yen weakness is yen higher. Consequently, oil higher, right? Very technical, like I say. Nothing related to fundamental. These are the oscillation of oil. As you guys can see, they trade the same side, right? You see the peak over here, how the index drop, oil remains sideways, how they rally together, how they drop, how they trade together out to here, how they drop. Look at the oscillation on the peak, on the top, my bad. Using first and second degree. Now this one is here and it dropped. They are identical, right? Now, what is the caveat here? What is the message here? That this is one of the few instruments that they have not yet reached the equal-X in the grand super cycle, right? Which it comes around 10,400. Which it comes around 10,400 there, this instrument. It hasn't reached the equal-X at the grand super cycle. So this is telling me that this is going to extend. This is telling me that this instrument is going to extend to the upside. And if the index extends, guess what? Oil will be supported, because it needs to reach at least this area, right? They are identicals. Now, we're going to overlay the SEG, for example, that we've been talking to the FTSE. And no matter what the market does after, when the SEG reach this equal-X here, it's going to fly. It's going to rally. And that will support also the FTSE higher. This low in the index is this low. And if I throw and I put oil into this equation, they all trade the same oscillations. At least for us guys, it's very simple, very clear. So I believe, again, and I repeat it one more time, that there is a highest percent, 80%, that oil, it will hold this low because the SecGen needs to rally and this one needs to be supported. Also, we're going to take a look about the SPY. SPY is very bullish. Now, no question asked that SPY here, it reached from the all-time lows we are within the blue box. Remember, the FTSE hasn't reached that area. But because there is the bounce in the SecGen, SPY is going to stand against the lows of this December. Here is when oil reached this area. And the way forward in the SPY here, it will be the pullback in oil and the low in the SecGen. So, in conclusion, I just want to make the point to you guys, or that the market is not only about oil, that the market is not only about SPY, it's not about the FTSE, it's not about CSK, it's not about the commodity index, it's not about CVI or KGN or SecGen. I want to make the point to you guys all that this market is about an overall performance of the market in which everything is related, in which everything is related, in which everything needs to make, everything is related, right? And it's about market that unless you do this multi-market analysis, you cannot be trading using Elliott Wave. Why? Because no question asked, if I want to be a waiver and I want to be bearish, it doesn't take long for me to do this, guys. I'm being honest. It doesn't take long for me to do that and make oil make a new low right here. Possible? Yeah, 20%. But it's hard for me to see oil declining another $40, $30 when GCC is at equal X, when CVI are ready to this high, when the SecGen, it needs to bounce here. It's hard for me to see that. So, in Elliott Wave Forecast, we do this multi-market analysis. And what we do is we present the clients with the most reliable path of the higher the path of least resistance with the trend, with the obvious. And for us, the obvious is that it's not impossible, it's a minimum chance that oil decline in order to make a new low over here. Right now, it's trading at 55. It needs to break 25. That's $30 decline with these market conditions that we have. So this is our view in oil and why we do believe that oil is gonna break higher, that is gonna remain sideways, like we're showing. So the projection is clear, like I say, 93 to 105 by next year. And buying the dip is the right trade. So, like I say, we cover in our regular basis 78 instruments. They are all overlaid over there in that chart right there. We cover about what we talked today: oil, CSK, Cayenne, FTSE, S&P, and future and spot. We cover all of them. We also cover, or we track more than 78 instruments, because the only way that you can survive in trading is tracking everything. I strongly recommend, it's a free seminar, to be honest with you guys. I strongly recommend to you guys, or that if you guys like the video, there is nothing that you guys I mean, we know any type of commitment. It's free. Take the free trial. You're gonna learn a lot. If you learn in today's video, which is, this is a conclusion, the seminar was a little longer. If you learn with this, we do this in the regular basis every single day in Group 1, Group 2, Group 3. 3 live sessions. We send signals every day to clients. We present clients with the boxes and what they should do and what they shouldn't be doing. Take the trial. It's free. It's gonna help you. If you find this video that it helped you, take the trial. It's free. You can cancel before the 14 days. No commitment, right? So I hope that everyone enjoyed the videos and that everyone becomes a better trader and is at least change your mind and how to see the market. This is not only about oil. It's about the overall market performance. Thank you guys. All have a good night. See you guys.